You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Welcome back, everyone. Welcome back, Hamish. What's going on, friend? What you been up to?
Oh, not a lot. Pretty uneventful week, I think, in the markets.
Yeah.
Just had a quick look. The US market up a couple of percent. Australian market down 1%. Same old story.
We've been struggling for news stories. Like there's still been stuff to talk about, but we've been struggling for those really interesting news stories for a couple of weeks now. It's been kind of like this little dead period, I suppose.
Yeah, it gets a little bit like that, particularly in between, not always, but particularly in between the earnings season sort of periods.
Yeah, true.
I guess we're coming up on the next earnings season. Not quite yet, I guess. Maybe in about a month.
Yeah, a few weeks, a month away. Yeah.
Yeah, so that'll be exciting.
End of July, companies will probably start coming out and releasing earnings. That's usually what takes them like 3 or 4 weeks after the end of the quarter.
Yeah, I think so. Yeah, and then we have too much to talk about.
Yeah, exactly.
We have to pick and choose.
Yeah, that's true. We want to do all these earnings reports. We have to space them out over like 3 or 4 weeks.
Yeah.
But no, there's still some interesting things. There's some crazy things to talk about today. Most notably, of course, there's now a new runner for the US election. But I guess we'll get to that in a second. I suppose we should go through our sponsor first, and then we'll get stuck straight into it.
Yeah, so today's episode is sponsored by Sharesight. So as you guys know, Sharesight's an application that you can use in order to track the performance of your stock portfolio. And it will allow you basically to keep track of all of the different types of gains. So capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains, if you're buying shares internationally or hold foreign currencies. And then the main reason why I use it is when it comes to tax time. So Sharesight allows you to generate up to 10 different reports that can be used at tax time to easily work out things such as capital gains, dividend income, and more. And you can try Sharesight for free by heading over to sharesight.com/young investors. And if you use that link, you can get 4 months free for a limited time when you sign up to a yearly subscription. And I saw a comment on the latest podcast. Luke said, tax time, so I signed up to Sharesight using your referral code.
Yes.
So everyone go out and be like Luke. Be Luke.
Be like Luke. Good on you, Luke. MVP for this week, Luke. Good on you, Luke.
You get the gold star.
Yeah. No, I've said this for the last couple of weeks, but it's a good time. If you are considering it, it's a good time to kind of take action because it's right at the start of the financial year. So you get yourself set up and it tracks everything for the whole next financial year, makes it super easy. You just download all your reports and either take it to your accountant or do your tax return, and it's pretty dang simple.
Yeah.
So it's a good platform, and we're happy to have them on as a sponsor too, because they do offer really good products. So
yeah, it's fantastic. I actually just posted a review video going through Sharesight. So if you want to go, if you're interested in that, go check it out. And you can kind of see some of the features that I use in order to track the performance of the portfolio, and then also sort of some of the tax things that I use.
Cool. I have to check that out. Did that come out today or?
Came out yesterday. So
yesterday.
Well, Wednesday. So not yesterday for those listening, but
not that was so long ago, man. It's Saturday. Come on, what are you talking about? Anyway, all right, let's get stuck into it. So, holy moly, what the hell is going on in this here world that we live in?
Nothing surprises me.
Kanye West is running for president of the United States, and to me, that is the craziest news story of the week. Maybe a little bit crazier is that Elon Musk comes out and says that he's giving Kanye his full support.
That was
What
great.
is going on? I mean, I'm not a huge follower of politics. I don't particularly care. I don't think it makes too much of a difference, but man, like, come on, Elon. Like, what are you doing? I don't care. Kanye West can run for president, but Elon Musk, my boy, what are you doing?
I don't know.
Anyway.
Surely he's just posting that for Twitter, the Twitter memes kind of thing.
I don't know. I honestly don't know, because here's what happened, right? So Kanye took to Twitter on the 5th of July saying, "We must now realize the promise of America by trusting God, unifying our vision and building our future. I'm running for president of the United States." To which Elon basically immediately replied, "You have my full support." However, then another Twitter user links into that thread an article of Kanye doing some, I don't know, like a press conference or something after he announced this. And basically he was talking about how he's anti-abortion and anti-vaccination as well, which to me, the anti-vax stuff, I'm like, whoa, are you serious? And then so this anonymous, or not anonymous, but this other Twitter user posts this article saying, "Hey, do you know that Kanye actually believes in anti-abortion, anti-vax?" And then Elon replies saying, "We may have more differences of opinion than I anticipated."
Have you seen that video of Kanye where he says that slavery was a choice?
What? No.
There's a shocking video going around. I don't know when it was from, but he basically says, well, slavery for 400 years, that sounds like a choice. That's like the direct quote.
Oh my gosh.
Yeah, he's
wowee.
I'm not sure how many people have political opinions that line up with Kanye, but he said a few times that he was going to run. He said he was going to run in 2024, and then he said in 2020 at some point in the past as well. So he's sticking to it. I mean, he hasn't filed any paperwork or anything as far as I know to actually go forward with it, but he's sort of, maybe he's taking a leaf out of Trump's book and get some free promotion leading up to it. Doesn't really matter if you do well or not. Maybe. Your name will be in the news for the next 6 months.
True. That's true. Why not just say it? Just say you're running, even if it never eventuates into anything, then you just get free press for a little while.
Oh dear.
People talking about you. It's marketing, I guess. It's just marketing. But that's pretty nuts. Oh man, I'd be a little bit concerned if the next president of the United States was Kanye West. I'm not going to lie. I'd be a little bit concerned.
Yeah, I
was pretty concerned when Trump got elected as well. Oh, wow. I'm just wondering, like, is this now a new age where essentially leaders of countries are just people that are super famous?
Yeah, I hope not.
I hope not as well. But we've already seen that trend. Is it going to turn into, it doesn't really matter what credentials, qualifications, what views you have. The presidency or the prime ministership of a country is literally just going to be marketing. Like if you are the biggest name and if you market yourself like better than the rest of them, then you will win. Like it doesn't matter what your policies are. It doesn't matter what your credentials are. If you market yourself better than everyone else, then you will win. And the presidency or the prime ministership just turns into a job where you just it's just advertising as opposed to actually standing up for something or policy or anything like that.
Yeah, I mean, I think for a very long time, there are those people who get involved in elections just to sort of promote their book or something that they're doing, and they know that they can get a lot of publicity out of it. But it's really wacky. It's a strange world where this is going on. But
idiocracy.
I'm never surprised, I think, anymore. It's like, what's coming around the corner?
We've lived through so much stuff now that's just, if you lived 20 years ago and someone from the future came and said, you know what's going to happen in the next 20 years? You would sit there and go, nah, absolutely no way. No. And now we've lived through all these different things that just seem completely bizarre that have actually happened. And it seems like nothing can surprise you anymore. It's just like, yep, that doesn't surprise me. You basically say that to anything that happens now.
Yeah. Oh dear.
Anyway.
Oh dear. What will we have from Twitter next week?
We should just make a Twitter podcast.
Yeah, honestly, there's plenty of content there. Plenty of content just on Elon Musk's Twitter feed, Trump's Twitter feed. Oh dear.
Anyway, let's put a pin in that one and move on, shall we?
Yeah. We can move into some more, I guess, a little bit more investing related. We've got a couple of stories to talk about with Buffett. We'll save the big one. I think that most people are probably thinking about. But just yesterday, Buffett announced that he's giving away another $2.9 billion in Berkshire stock to a variety of charities. So for those who are unaware, Buffett and a bunch of other billionaires have signed a pledge to give away 99% of their wealth leading up to and then after they pass away. And he's left most of his wealth. I think he's going to leave most of it until after he passes away. But along the way, he's been sort of slowly giving away some of it. So he gave away most recently 16 million shares of Berkshire. And this was to a range of different foundations, but a couple of the most notable ones, I guess, the Bill and Melinda Gates Foundation, and then a number of other charities run by his late wife and then his children as well.
Right, okay. Yeah, I was actually looking into the Bill and Melinda Gates Foundation yesterday, and that foundation has a monster stock portfolio. I think it's like $17 billion or something like that.
Wow.
And 47% of the foundation's stock portfolio is in Berkshire Hathaway.
Oh, really? That's interesting.
Yeah, monster position. I mean, it's not totally surprising considering, Bill sits on the board of directors and I think basically every year, doesn't Buffett give the foundation even more shares? So yeah, so I'm not surprised. It's smart. And, Bill and Buffett are obviously pretty close friends. And, if I was going to have a stock that occupied 47% of my portfolio, Berkshire Hathaway wouldn't be a bad one, not just because, it's run by Warren Buffett, but also because, if you were to have something like Facebook as 47% of your portfolio, well, then you're in a little bit of a vulnerable position because Facebook only does one thing. It's just pure advertising, right? But Berkshire Hathaway, they've got just a plethora of wholly owned businesses in different industries or different sectors. And then they've got partial positions in lots of other businesses that are in even more industries and even more sectors. So it's pretty well diversified.
Yeah, it's pretty much just a massive diversified basket of businesses now to the point where it is. And obviously, I have no idea how that would perform in the future, but you would expect it would perform, relatively well. You would hope so, at least. I think your downside risk would be pretty protected through the diversification. True, that is true. Although another thing that sort of came out this week was how big Apple is as a part of the Berkshire portfolio now. I think it was 46% or something like that. It's coming up to 50% of the stock portfolio. So while they do have a lot of businesses, a substantial amount of it is concentrated in Apple now. But that would have just been from the stock price. Whoa, Apple stock's at $381. Yeah, it's been on a crazy run. Oh my gosh. What? I'm looking. I have not even been keeping track of this. What's the market cap on Apple stock at the moment now? 1.65 trillion. Wow. 1.65 trillion. It cannot have been that long ago where everyone was waiting for it to hit $1 trillion. It can't have been more than a year and maybe a bit over a year. This is insane, man. Tim Cook, enjoy your bonuses this year. That is insane. I'm looking, so 23rd of March, it was at 224. Now it's at 381. Wow. So in just a couple of months, it's hit 100 plus 157%. Oh, sorry, not $157, 69%. Wow. 70%, yeah. That's insane. Whoa, wow, that's just bonkers, man. Oh, I don't even know. They don't seem to have come out and announced anything crazy to cause it. I think it's just they're just getting caught up in the market maybe. Yeah. Am I missing something here? I'm not sure. I haven't looked into Apple in a long time, but it's kind of interesting that even at Buffett's size, he was able to find something that's delivered such a great return for him. I think I don't know what I'm not sure at all what his average price was. I feel like it was around $130 or $140 a share or something like that. Somewhere around there. Back in 2015, I think he started investing in it. But
He started investing around just over $100 a share, I think.
Yeah.
And then continued to buy, but that was only a small position. When it was at like 100, he continued to buy as it kind of ran up a little bit.
Yeah, and we were talking about the other week about how there's such limited options that Buffett could put money, a substantial amount of the portfolio into. And even with those constraints, whether he outperforms the market over the next decade, I don't know, but he's still finding businesses that can deliver very substantial returns, or at least Apple has up until this point. Obviously, I don't know what's going to happen in the future, but it's just fascinating to see that even with his very, very limited options, he's still able to find really good investments, or at least, moderately good investments. And I think that's kind of something to say to individuals who are investing substantially less money, that even if he's dealing with, 20 or 30 businesses, maybe even less, that he could possibly invest into, and he can still select the ones that, or find some that can outperform. There's got to be more at a smaller scale that can do the same, or a larger number at a smaller scale that can do the same.
Absolutely. Yep. Moving on into the next Buffett news story. Should we move on into this next one as well?
Yeah, absolutely. Yeah, this is probably the main story that people are thinking about this week.
Yeah. So if you haven't seen, Warren Buffett, or Berkshire Hathaway, has made a $9.7 billion investment. So this is their biggest investment since they started buying into Apple back a few years back.
Oh, really?
I believe so. I don't think they've made a nearly $10 billion investment since then. So
right.
All of the other investments, I think, have been a fair bit smaller. But anyway, so the investment that they made was in a company called Dominion Energy. And essentially what they did, they didn't even make an investment in the company. They made an acquisition of some of Dominion Energy's assets, and they also took on some of their debt. So what they did, they paid $4 billion for the Dominion Energy gas network assets, which include 7,700 miles of natural gas storage and transmission pipelines, and 900 billion cubic feet of gas storage. Whoa. So, they essentially Berkshire Hathaway bought these gas assets to kind of bolster up Berkshire Hathaway Energy, and they paid about $4 billion out of the kitty and took about $6 billion worth of Dominion Energy's debt to make the deal happen. So, I thought this was kind of interesting. It's kind of two different sides to the story, I suppose, because on the one hand, you've got people that are criticizing Berkshire Hathaway for investing in, gas, obviously non-renewable energy sources. And what we've seen over the last little while is that, people like environmental groups and whatever are really putting the hammer down, and they're trying to make it as hard as possible for energy companies to lay new big pipelines and whatnot, whether it be like oil pipelines or gas pipelines. And they've just been holding up those kind of projects through various kind of legal means. So there's been a lot of fight saying people should just divest from these kind of pipelines, non-renewable energy. And then there's the other side of the coin, where Berkshire Hathaway, they know that as much as you might like natural gas to no longer be used, it's going to continue to be used for a very long time into the future. And it's even going to there's going to be a much higher demand for it in the future, because natural or gas is kind of talked about as this transition energy source away from things like oil and coal. So while oil and coal are getting phased out quite rapidly, natural gas is kind of that buffer while renewables get more and more popular. And then eventually natural gas will be phased out and renewables will take over. So there's kind of that plan. I think that's probably what Buffett saw here, is that I don't think he'd be making massive new investments in, coal, because that's getting phased out quite quickly globally. But for natural gas, they're actually anticipating that the demand for that will go up and up and up over the next, say, 20 years, even though renewables are still going to go up and up and up as well. So, I mean, me personally, I'm just of the opinion that, renewable technology is now there. So just put all of your investment dollars into renewables and let's just get this thing going. But you can see from Buffett, someone who obviously is a bit more old school thinker, obviously much more focused just around purely what the business opportunity is. He's made a smart economic investment. He's got it pretty cheap. It's going to add hundreds of millions of dollars to Berkshire Hathaway's net income. And it's an industry where the demand is probably going to continue to go up for at least the next couple of decades.
Yeah. I wonder at what point energy tips towards renewables, and then you kind of see that hockey stick of everyone going renewables. I wonder at what point we'll see that happen. I don't know. I don't know if we'll see it soon. I hope we kind of see it soon, but I'm not sure how long it'll take.
Yeah.
But yeah, I mean, obviously he's sticking to what he knows best. Energy is a big part of Berkshire, and it's interesting to see that he's just purchased some of the assets. It's not necessarily that he's made an investment in the business. But my understanding of energy in any form is very limited. So I don't.
Oh, I'm no expert either. I'm absolutely no expert in energy either. This sounds I like talking about renewable energy, but when it comes to traditional forms of energy, gas and oil and coal, that stuff bores me to death.
Yeah, I mean, it's also one of those industries that I see being regulated or at least it's watched very carefully by governments, and that makes me nervous in a lot of ways. Businesses where there's a lot of regulation already, such as banking, for example, and especially with what we've got right now, where you would expect as more people want people to be using renewables, you would expect there'll be much more of a push for legislation to steer businesses in that direction. So
yeah. And I found it interesting. This deal actually happened because Dominion Energy have kind of shifted their focus I believe under pressure to focus more on renewable energy assets. So they're actually kind of trying to divest from dirty energy sources. So I think this is actually what made this deal happen, is that this energy company is trying to get away from those assets. So Berkshire Hathaway said, well, actually, you know what? It still makes economic sense. We don't care so much about the whole climate argument, so we'll step in and we'll make that smart business decision. So I found that kind of funny.
Yeah, that is. That's hilarious. Yeah, I mean, Dominion Energy. I'll have to have a look. I know absolutely nothing about energy companies. So
I really don't either. I'm trying to provide as much perspective as I can, but really I got very little interest in energy companies.
Yeah.
Anyway, shall we move on? Talk about something different?
Yeah. What else have we got? We've
I don't know.
Back in my hometown, Melbourne. We're back into lockdown.
Oh yeah.
Oh god.
Yeah. I read this article. Have you noticed that people have been going crazy at the supermarkets again?
Yeah. So for context, for people who are not in Melbourne, or maybe people who are not in Australia, Australia was doing quite well with the whole the virus thing, but Victoria's kind of seen a bit of a resurgence in it. Yeah, I mean, it doesn't surprise me. Every time I go out, I don't go out very often. Just, I don't know, just the nature of my business and stuff. But like,
Hamish is a loner.
Yeah, that's really what it is. We've spoken about this on the podcast. We'll save this one for next week. No, but on the rare occasion that I actually leave my house, there's so many people outside. It's ridiculous. I don't know where all these people are going. It's shopping center. It's just crazy, and it didn't really surprise me that there was it sort of came back. So now we're in lockdown, which is great. I mean, it doesn't really affect me because, as you know, I'm alone.
I don't go anywhere
anyway.
Nowhere to go, no one to see. I'm all good. Just chuck on some Netflix and just chill out for the rest of forever.
Nothing changed. Just look up. Oh, we're in lockdown. I didn't notice.
I didn't even notice. What is this coronavirus stuff? I haven't heard of it.
Yeah, no, but particularly at the supermarkets, there's been some crazy shopping going on. It's just ridiculous.
I was just reading that just a day after they were scrapped, supermarkets have reinstated buying limits across Victoria as shoppers raided the shelves. Stores across the city were stripped bare on Tuesday night as customers made a mad rush to stock up after the Premier reintroduced Stage 3 coronavirus restrictions. I'm trying to just skim through this article.
Just stop, people. You don't need 20,000 rolls of toilet paper.
It's exactly right.
Just calm down.
Right. And here's the thing, coronavirus doesn't cause diarrhea, so you really don't need more toilet paper than usual. Woolworths reinstated a purchase limit of 2 items per customer early on Wednesday morning across 27 product categories in Victoria. Coles put product limits on 20 products at stores in metropolitan Melbourne and the Mitchell Shire. Let's go back to the Shire.
The Shire. Jeez.
But yeah, there you go. It's starting up again. It's kind of interesting. I think we knew this would happen, but how we had that first wave and everyone went crazy, and then we kind of got on top of it, started opening things back up, and here's another wave, and now we're going to have to shut everything back down again. The thing I just wonder is how many cycles do we have to go through? How many cycles where, it's getting better now, we'll ease the restrictions again. There's even more people with it. We got to close everything back down again. I wonder how many times does that have to happen?
Yeah, well, I mean, I would think that until there's a vaccine or unless people just stop caring, we're going to have to keep going back into lockdown. Either one of those two things is going to happen. Either there'll be a vaccine and we can open up, or it'll just get so out of control that everyone's like, we can't control it anymore, so we'll just let it run.
Yeah, it's interesting because that's kind of like, you can look at those situations playing out like Australia versus America. Australia is very much like, we really need to make sure this doesn't spread. And America's at a point now where they're just like, yeah, whatever, just open it all up. Who cares? It's going to do its thing. It's going to run its course. I mean, they're at, we were talking about this last week, right? I think, were we?
Yeah.
Where they're at over 50,000 new coronavirus cases each day. Think about that. For us as living here in Australia, how many new cases are in Victoria each day? Maybe like 50 or something, or even less than that? Or
well, the Premier, Dan Andrews, was talking about this. He was saying, well, when the cases are 20 cases a day, 10 cases a day, he said that typically for every person that gets the coronavirus, they need to reach out to about 10 people who that person has had recent contact with. Yeah. So if you have 20 or 30 people a day, you can physically reach out to and talk to all of the people who are potentially at risk of getting it. Whereas once you get to 200 a day, 300 a day, and then you get to something crazy like the US where you have 50,000 a day and it's heading for 100,000 a day, you physically cannot contact all of those people. It's actually out of control at that point. And it gets out of control quite quickly. I mean, even if you had, I think in Victoria, there's maybe 150 cases a day at the moment. That's still, if that's 10 people per person they need to contact, maybe even a little bit more, then you're talking about 1,500, 2,000 people each day they need to contact new people.
It's so interesting.
Even that could be challenging to keep on top of. And then out of those 2,000 people, it just takes one person to break the rules or to go see someone new or to not tell people where they actually got it from. And then it gets out of control again. So it seems like, I don't know how this is going to play out. But it seems like I was very surprised at how well Australia handled it in the first place. I thought that it was just going to...
we did really well.
Yeah, I thought it was just going to go spiral out of control straight away. But
it's super interesting and exactly right. That's why I just like look at the United States and I just think that there's nothing they can do now. Exactly from your point just there, whereas here we can reach out to 10 people and say, hey, look, I might have come into contact with you. Just please don't, get yourself tested or something like that. Go and get a test. In the United States, 50,000 people getting it per day can very easily snowball to like 80,000 to 100,000, 150,000 new cases per day, at which case it's just unstoppable. It's going to sweep through the whole nation. Everyone's going to get it. You basically, there's no rules or lockdown, no lockdown rules that you could implement that will, get rid of that problem. So it's just a case of, all right, it's too late now. We didn't care about it enough when it was getting worse, and now it just is what it is, and the consequences are what they are, and we just have to deal with that. So
yeah, I wonder how long until we'll see a vaccine. Let's do a classic.
Yeah, I don't know.
Let's do a classic Young Investors podcast guess where we never come back and actually check.
I reckon I'm optimistic. I reckon 9 months from now.
9 months from now, we'll find one, or it'll be distributed, start to be distributed?
No, I think 9 months from now, they will start to be mass distributing a coronavirus vaccine. The reason I say that is because I've seen a couple of different papers or people talking about these different papers that have shown some effectiveness.
Right.
Granted, like a few of them are like effectiveness in mice that have been given coronavirus. Obviously, that you can't just apply that straight to humans, but I mean there are some, as far as I'm aware, there are some tests that are showing some promise. So I hope so. I don't know.
Yeah, 9 months.
What about you?
Yeah, I don't know. I'm
optimistic.
Yeah, I was probably going to say about 12 months or so. Yeah, I think it's going to be quite a while before. I mean, even at the point in which we find out that there is a viable vaccine, it's going to be a long time before that gets into production at a scale that can be distributed across the world to literally everybody. So yeah, I don't know. It'd be interesting. True. We'll definitely come back to this. we definitely won't. But
stop lying, Hamish.
Sarcasm indicator on.
Yeah. All right, what should we talk about next? Oh, here's one. Have you been hearing about this? There's literally millions of Australians that are pulling out their super early because they are, quote, in financial hardship due to coronavirus. Have you heard about this?
Yes, I have. It's
So there are some. I should say that sounded a bit mean what I just said there. There are people that are obviously in genuine financial distress and need to draw money out of their super to make ends meet. And if you're someone that's in that position, then if that's the difference between you and your family suffering versus getting through this period of time, okay, then by all means go for it. The skepticism in my voice is because there are a lot of people trying to draw out their super that do not need to draw that money out. And quite frankly, I would not advise people, the average person, withdrawing their super, especially when, what was it here? There was something about most of the people being under the age of 35. I mean, that's worrying considering that super is like your forced investment account for your retirement. And obviously, because it gets invested, it just compounds and compounds over time and actually does set you up for retirement. The younger you are pulling out super, the more damage it's going to do to your retirement. So, it's pretty crazy.
The problem is just that most people with any money that they have access to, a lot of people will just spend it and just flush it down the toilet. And that's why you need something like super where it's your money, but you can't touch it.
You're not allowed to,
It's honestly, it doesn't surprise me that the moment that they say, okay, you can access some of your super, that there would be people who don't need to access it, but they just feel like, I don't know, just people who just don't think about the long term in a way that they should.
Humans are incredibly short-term thinkers. I don't know why. I'd be really interested to understand why humans are so short-term focused. Is it something to do with our perception of time and the fact that our lifespan is like 80 years, and that's a very hard period of time to be able to comprehend? I don't quite understand, but it's so true. Humans are incredibly short-term focused. They really struggle thinking about the long-term situation.
It is strange. Surely part of it has got to do with memory as well, because if something has just happened to you, like the emotions that are attached to that are very vivid. Whereas, give it a year or so, and if you're looking back at anything that's happened a couple of years ago, for most things, I guess, it's very hard to draw emotion from those things, I think. You can draw a little bit, but obviously not to the clarity of if it just happened to you. And that's got to have some impact on those sort of decisions.
I wonder if we got any psychologists out there that listen. If you're like a psychologist or you've kind of studied this, I'd love to hear a comment. I'd love someone to explain why are humans so short-term focused. But going back to the article, so I've got it here from the article. Weekly figures provided by the Australian Prudential Regulation Authority show $18.1 billion has already been siphoned from the country's near $3 trillion superannuation sector by almost 2.5 million people.
Wow.
So 2.5 million people are trying to get these $10,000 early payments out of their superannuation.
Wow. That must be almost a tenth of the population. Maybe even more than a tenth if you take out people who don't have super, and people who are under 18.
Yeah, true.
It's a lot of people.
That is a lot of people. That's crazy. That's crazy. Apparently there's no actual strict checks to be able to take this money out of your super. You just have to current measures are a self-assessment with no upfront documentation checks. Wow, that's crazy.
Really?
Yeah, apparently. I don't know. I'm just reading what the article has to say. Maybe the article's got it wrong.
Let's do it.
Maybe I'm not interpreting. Yeah, let's go. Come on. But I was reading this article and like lower down, it was talking about like how people under 35 are taking it out and, putting it towards, buying alcoholic drinks and putting it towards gambling and that sort of stuff. And that just, it made me cringe. I was just like, how can we be doing this?
Yeah, I think I read or heard something on the news about that, how there was a decent percentage that had gone directly into the gambling industry. That's concerning that people are willing to do that. They'll take out something. I mean, I think it just comes back to why gambling is so popular. People would much rather take a punt on the lotto or at the casino rather than lock in safe, consistent 6% return over the long term or something like that.
Take a dividend or something like that before you go to the casino.
Oh dear.
So I can see you've withdrawn $10,000 from your super account. How do you plan on spending that money? I took my super out. Now I'm gonna go down the pub and play the pokies.
Just $12,000 worth of lotto tickets. One of them's got to win, right?
One of them's got to win.
If you bought
oh dear. Anyway, hey, let's move on.
Yeah,
you've written some stuff down about Ray Dalio.
Yeah, this isn't really news or anything, but it's more of a public service announcement, I guess. But
PSA.
Yeah. So Ray Dalio's fund that he built over the past few decades, he doesn't work there anymore, but the fund that he built, Bridgewater, it's the biggest hedge fund in the world. They've basically been posting a lot of long form information, podcast style information about the current state of the economy. And then also how to handle your portfolio, and I think it's a really good thing to check out. It's on their YouTube channel. It's just called Bridgewater, I think, and it's a good way of getting a gauge of all of the different possible outcomes for I guess what is happening right now and what we could see in the future. I don't necessarily sort of agree or act on what their opinion is of what the most likely outcome is, but they do a good job of laying out all of the different possible outcomes. And I think that's really valuable because if you can just sort of listen to all of the possible outcomes, then you can think about, well, will I be okay? Or will I be okay, I guess, if each of these outcomes happen? And obviously Bridgewater, they're in the business of making bets on the economy. So they have an opinion about what they think is likely. I don't necessarily listen to that, but just to hear the range of possibilities is really interesting.
Right. Okay.
Yeah. And there was one sort of particular that I'm not sure if they have posted more since then, but the latest one that they posted was sort of talking about, they focused on sort of the divergence between the stock market, the financial markets, and the real economy. How basically, particularly if you look at the US market, right, the market went down substantially in March and April, and now it's pretty much back up to where it was before COVID, even though none of the effects in the real economy have really gone away.
Yeah.
Yeah. And basically they were talking about, so they obviously formed their opinion about what they think will happen, but they think that there's sort of a number of, I guess, most likely outcomes. One being that, well, I mean, the first thing is that overall the divergence, the gap between the real economy and the financial markets just cannot last forever. That the physics, the economics just don't allow for that, because
it doesn't work.
At the end of the day, if you buy a stock for a certain price, you pay a premium for it. At the end, it has to deliver you those returns. So the business has to produce profit and deliver that to you. If it doesn't deliver those profits to you, then those assets are not worth what you paid for them.
Yeah, exactly.
And this could basically result, they think that the two of the most likely outcomes are, one is that stocks fall to get back into the real economy. And I think that's probably the line of thinking that I guess someone like Phil Town runs by, where he has 60% of his money in cash or something. So he's betting on that the stocks will fall down to get back in line with the real economy. And as a result, he can then, and value investors can then invest the cash that they have on the sideline. But interestingly, they spoke about how stocks could also stay flat for a long time or even go up while the currency is inflated from all of the money printing. So it's not necessarily the case that stocks have to come down to appropriate prices, but it could be that inflation drives a decrease in the value of currency to reduce that gap. And I'm certainly no expert on this, and
I don't know either.
I highly encourage everyone to go check this out. But it's very interesting to sort of talk about all of the different options that can happen, particularly with federal governments and the Federal Reserve in the US and in Australia spending a lot of money on stimulus. They're printing a lot of money, and if that results in inflation, it's not necessarily the case, according to Bridgewater at least, that stocks fall. It could be the case that they stay high and it's the currency that's actually devalued.
Right. That's interesting.
Yeah.
There you go. Yeah, I've never really thought about it that way, but I guess it makes sense.
Yeah, and I mean, like I said, I want to reiterate this because they in these videos, they make a point to say what they think is most likely, and they bet on what they think is most likely. But I think the most value is just understanding all of the possibilities and making sure you're okay with your portfolio in each of those situations.
Whatever
Are you
happens,
not, if you're fully invested in the stock market, you should be worried that the economy isn't really lining up with that, because there's a good chance that stocks could fall down. And the same kind of sits on, if you're completely in cash, it's not necessarily safe just because it's cash and that you can buy things with it. There is also a good chance that the cash gets devalued, and why it's sort of a good idea to, well, in their opinion, it's a good idea to diversify into everything. They kind of, their opinion is just basically buy everything, and that way you'll capture an average of everything. I don't know if I necessarily agree with that, but it's an interesting, it's been a couple of interesting podcasts, I guess you would call them, that they've been posting. One actually had Ray Dalio in it, specifically talking about this, and then a couple were the chief investment officer. So definitely a good, definitely worth a look.
Where did you find that?
So that's on the Bridgewater YouTube channel. So if you just search Bridgewater, it should come up. I can't remember exactly what their YouTube channel is called, but it will come up. And there's one, their podcast style, so there's no visuals. So, but they go for about 40 minutes each, and they answer a ton of valuable questions. They basically have one person being the expert, whether it's the CIO or Ray Dalio, and then they have another person there asking questions that the average person would probably be prompted to ask if they were in that situation. So, what happens if stocks don't fall? And this is going to happen. So, very interesting.
It's on the Bridgewater Associates YouTube channel.
That's it. Go check it out.
Man, how do I have more subscribers than this YouTube channel?
How many subscribers does it have?
It's only got 39,000.
That's sad. I mean,
that's real sad.
That sounded a bit harsh.
Then again, they've only got 1, 2, 3, 4, 5, 6, 12, 18, 19, 20 videos.
Oh, okay. So it's relatively new, I guess. Or
actually, no, it's not new. I just don't think they haven't posted regularly.
Right.
So the oldest video is 2 years. Yeah, 2 years, 2 years, 2 years, 1 year, 1 year. But yeah, now we've got 1 day, 1 week ago, 2 weeks ago, 2 weeks ago, 1 month ago. So it's been more regular, more recently.
Yeah.
But go check it out. I mean, just do yourself a favor and just click the subscribe button to that YouTube channel and watch everything that they put out, because, you'll just be a better investor if you just watch everything that comes out. It comes out of Bridgewater Associates. Like what you said, you don't have to agree potentially with what they say, but just to listen to the analysis, and the fact that they do go through, like what you're saying, all the situations that could happen. At least you get in a more informed position as an investor on what these guys that have had a great run of success actually think about the different potentials in the economy, I guess, in the stock market.
Yeah. Should we get into some Q&A? Go through some Q&A questions?
Yeah, let's do it.
Yeah, so
let's do it.
Where can I ask this first one? All right, I'll ask this first one to you.
Sure.
What's your opinion on currency hedged ETFs?
Currency hedged ETFs. I really don't have an opinion on them. It must be said. I mean, if it's something that you're interested in, I mean, go for it. If it's not something you're interested in, then don't worry. Currency hedged ETFs, as far as I understand, are just the same as your typical ETF, except they've got that insurance against fluctuations in the exchange rates. So, you know, if you don't want the effect of various exchange rates to impact your ETF returns, then sure, currency hedged ETF, go for it. If that's not something that phases you, then, I mean, you don't really have to worry about it. Personally, I don't really worry too much about exchange rates. Maybe I'm wrong in saying that. I'm not saying that that's correct. Maybe I've been naive or ignorant about something, but I really don't tend to worry too much about what the exchange rate is, or protecting myself through the currency or anything like that.
Yeah.
I don't know. What do you think?
I think currency probably falls into one of those categories that Buffett calls important but unknowable, meaning that certainly currency has an impact. I mean, if you're buying US shares and there's a sort of a change in the relationship between the US and the Australian dollar, then that will have it can have an impact on your overall return. But is it something that you can predict? Is it something that you can anticipate? That I don't know. I mean, I don't really know a whole lot about how currency hedged ETFs function specifically, but I know that I will probably need two major currencies for a very long time, probably not any other currencies, and those will be the Australian dollar and then the US dollar if I want to buy US shares. So just holding a bit of both is kind of a way of hedging in that way, that if one moves substantially, if one deviates from the other one, then I'll benefit from holding some of that currency. But other than that, I don't have too much to. It says here the
fundamental difference is that the currency hedged ETF contains positions in currency forwards, which are essentially futures contracts on currencies. So that's how they. So it seems like it's much the same thing, except they just have that little addition of those currency forwards, which is how they balance the risk or the hedging of the currency. Anyway.
Yeah. All right.
There you go. All right. Shall we move on to this next one?
Yeah. What have you got?
So this one here is, how often do you balance your portfolio, and how do you balance a portfolio? What's your opinion on this one?
Yeah, that's interesting. I mean, my position is very similar to a lot of, I mean, I say this a lot, but a lot of what I do is just based in what Warren Buffett is doing, and then also in his principles that he's taught over time. And his principle on balancing is that if you have a great business, you don't want to just sell that business because it becomes a larger percentage in your portfolio. So if a business is a great business and it goes from 10% of your portfolio to 12, a lot of hedge funds, a lot of investment funds will trim that position back to 10% and put that 2% somewhere else. But if it's a great business and as long as it's not undeniably overvalued, I think those are probably the two criteria in which I would reduce a position. Or if there's substantially a better opportunity. I guess those are the three. So if it's no longer a great business, if something changes, first of all, I'm not going to trim it. This is, again, Buffett's principle is you wouldn't want to trim a business because it takes on a bunch of debt and you no longer feel comfortable with it. You should completely remove that investment if it's no longer what you would classify as a great business. If it was overvalued, I would probably, and this would have to be substantially overvalued. I mean, if it had to perform really, really well, and even then it wasn't going to deliver a decent return, then maybe I would sell some of it or all of it, or if there was a better investment opportunity. So if I'm investing in one business and because its price has risen, I think the expected return is 4%, and I've got another one that's got an expected return of 16%. Maybe I put some money from the one that's offering a low return that's had a huge increase in its stock price, move some of that money into another one. But other than that, I just want to have 5 to 8 businesses in a portfolio, and the weight of them, I don't really have a limit on the weight of each one. It will really just depend on which ones become cheap. If there's only a couple that are really cheap, then I'm going to be buying more of those. If they're all cheap, then maybe I'll be buying a little bit more evenly between those businesses. But beyond that, it's I don't really do too much. Balancing isn't really something that sort of takes a major role in my portfolio.
Yeah, I don't really do it either. That's the only point I was going to bring up, is the one that you just touched on, is that if you've got two companies that you both like, you like them both equally, but one of them is sitting right down there at like a 50% margin of safety, and maybe the other one's only at a 20% margin of safety, then in my brain, it doesn't really make sense to, because your portfolio rule is that you only have 10% of your portfolio in each stock. It doesn't make sense to me that you'd put 10% of your money in that one stock that's offering not so good of a deal, and you only put 10% in that one which is offering this amazing deal.
Yeah.
That just doesn't click with me. I mean, for me, I'm looking at these different companies, and we are saying if you like the companies the same, then if you're getting this drastically better deal in this other company, then it's like, well, I want to put more of my money into that one, because you model things out and you're like, oh, my potential return over time is much higher in this company, so I want to put more of my money in towards that one than this other one. So
yeah, and
that's the only thing that I would probably say about that.
Yeah, as time has gone on as well, Buffett has more and more said that he has just found it a much better idea to hold on to businesses that he thinks are great. He's leaned much more into holding and finding really great businesses and buying them consistently over the long term. Because ultimately, I mean, if a business goes up a ton in price, it doesn't necessarily mean that, you can predict that it's going to come down and you can, sell at the top and then buy back in when it's a little bit cheaper. It's a much better idea to just recognize that for the most part, what the market does, particularly in the short term, is a little bit up in the air. And if you just hold that business over the long term, then it will do quite well for you. And I think, Buffett's kind of showing us that with his 40-something% position in Apple now, 40% of his portfolio. He's not selling bits and pieces of that.
He's not trimming that.
No. And why would you? It's a great business. And there's no, maybe it would have to perform, a little bit better now because its stock price has gone up to deliver those higher returns. But there's no reason to say why it couldn't outperform people's expectations. Yeah,
that's true. That wouldn't faze Buffett at all. I mean, you look at the dates that he's bought some of these major positions in his portfolio, and they're like 2-3 decades ago. Yeah. And he like in Coca-Cola, I think he bought it like more than 2 decades ago, and he just hasn't really touched that position ever since. But he still holds it. He still likes the business, but he hasn't bought more. He just hasn't really touched it.
Yeah, he has that with a few. American Express. There's a fair few businesses that he's just held for a very, very long time. So it's quite impressive to kind of have that discipline, I guess. I mean, with Coca-Cola, he had loved that company since he was a child, and he waited until he was, I think in his 30s or 40s to invest in it. And then he held it for 40 years or so, or whatever it is. But it's fascinating to watch someone do that. Go from having the discipline to wait 30 or 40 years for it to get cheap, and then hold it for 30 or 40 years. It's fascinating.
Yeah. I want to do this. We'll do one more and then I think we'll finish up. I want to do this one here. This one says, I'm 16 and I own a couple of different shares, but what is the best advice you can give me for my future? Now, obviously, when we answer this question, we can't give you any sort of like individual financial advice or anything like that. But I thought the way that we might come at it is that, if we, now you're 20, whatever, how old you are, a couple of years, 22, is that right?
Yeah.
Yeah, and I'm 25. If you went back and you had a 16-year-old version of yourself you could talk to, what advice would you give to your 16-year-old self?
Yeah, that's a good question, actually. I would say, particularly when you're that young, what is going to have a very material impact on building a portfolio is not necessarily the return that you get, particularly when you get started and you have a small amount of money, but how much you can save and contribute to a portfolio that will maybe you keep it, whether you invest it or not, putting money aside as an investment, recognizing that it's for retirement or when you buy your first home in 10 or 15 years or something like that. Yeah. So I would say, I guess to step away from the market just a little bit, I would just say, if you're able to, and if you want to, then go out and work as much as possible and save as much as possible, because, I know that the Coca-Cola and the lollies at the milk bar are tempting, but because I know I got tempted at that age into spending way too much money on coffee and things.
I think this guy's 16. He's not like 12, Hamish.
Trust me, I spent so much money on coffee when I was 16. Having like 1 or 2 coffees a day. Ridiculous. But just getting a job and saving as much as possible. And then, when it comes to investing, most people are going to want to go the diversified route. Passive, just finding something like an index fund to just consistently contribute to.
Yeah. Yeah, I think about it like that. I don't even really think about this just from an investing point of view, but just setting yourself up kind of view. And, when you're really young, if you want to get yourself to financial freedom sooner, everyone always talks about, when you're young, you got to save your money. But yes, saving money's got a place, but you can only save so much money. It's going to be a much smarter strategy for a very young person to try and increase your income as much as possible. So definitely focus on increasing your income. I'd definitely take some time to think about if there's any businesses you would be interested in trying to start. That's probably the single biggest thing that I would tell my 16-year-old self. I would basically go back and say, you are being groomed to be a worker through this school system, through this university system. You are being groomed to go and work a job for 45 years and then retire with a little bit of money, spend it over the next 20 years and then die. So, that doesn't sound that appealing to most people. And I would say, it's probably not appealing to most people. So try and get yourself out of that as much as possible. And this is me talking to myself. Obviously, it's not applicable to everyone. Some people just want to work a career and that's all good. But I'd tell myself, just forget about it. Try and start your own business. Try and accelerate your income as much as you possibly can while you're younger, because that's going to be the single biggest thing that's going to set you up better for financial freedom is business and higher income. And therefore you can use some of that higher income for investing. But yeah, it's all about setting yourself up.
Yeah, no, I think that's really good advice. I think, particularly the ages between 16 and probably like 24, 25 is by far the best chance you've got of starting a business if that's something that you're interested in, and just having a crack at it. If you're at university or whatever, and you have some spare time and you can sort of work on a passion project or anything like that, it's definitely worth a shot to try and build something during that time.
And the thing with business as well that I've only really discovered once I've done it, I might get some criticism for saying this, but for running your own business, it's I don't know, when you can start to consider larger kind of numbers, it's not actually too hard to generate the average full-time salary as a business owner. Obviously, that's not applicable to every business, but it's relatively achievable for you to be able to, accumulate a full-time salary each year from running a business. If you've kind of structured your business right, if your business is doing even just decently. So I would really think about, and even if it doesn't kind of achieve financial success in the first couple of years, if you can see that there is potential there, and if you can see that, if I put in the hard work and if I can get it to this point, then there definitely will be that kind of financial reward, I still reckon it's worthwhile. Because you never, it might just be a super successful venture, in which case you're going to do much, much better than if you're just kind of just working for someone else, getting the median full-time salary or something like that. I don't know. Do you agree with that or?
Yeah, absolutely. Yeah, I think, particularly I am much happier to make sort of an average wage running my own business than to make the same wage just working for somebody else. I think the potential in business to make a lot of money is obviously very attractive, but also just to have a little bit more control over your life and freedom and structure. And there's a lot of things that you learn from doing it as well. Discipline and
sure.
Look, you have to see what you did wrong and make changes to that. Be able to adapt to things that are happening. And there's certainly, I think there's a lot of benefits to if more people went down that path, or at least it gave it a shot.
Yeah.
I mean, obviously you can't guarantee that you will be able to build something that can then support you full time, or support a family full time or anything like that. But it's certainly worth a crack.
It's worth a crack
when you're young.
Particularly if you, exactly right. We were going to say exactly the same thing.
And should we leave it there for this week?
Yeah, let's wrap it up. Thanks very much, guys. Thanks for listening. We definitely appreciate the hour of time that you give us each week, and we're super keen to. We've got some more Q&A questions, so I'll make sure we answer them next week as well. But keep sending them in. We've almost gotten through our backlog of questions. I think we've only got three or four ones to get through maybe next week. So yeah, if you'd like to submit a question, just go over to the YouTube version of the podcast, youtube.com/The Young Investors Podcast. Did I get that right? I think I got that right. Yeah. And then just click on the most recent version of the podcast. It's the most recent upload, and leave a comment on that video asking a question, and we always tally them up and we chuck them in this Q&A section. But apart from that, thanks very much for listening, guys. We super appreciate it. Thanks, Hamish, for showing up as always on a Thursday morning.
No worries.
I mean, a Saturday morning.
Yeah. Saturday. Definitely Saturday.
Yeah, definitely. So it's like there'll be this massive news story that drops on like Friday afternoon or something. People, why didn't you talk about it?
Oh dear.
No, I think it's better. It's way better that we do this on a Thursday, record it, because we're so much more consistent.
Yeah,
but
absolutely.
Anyway, and then if something happens on Friday or even Thursday afternoon, then we just cover it next week. Anyway.
Yeah.
But yeah, anyway, there I go again. Starting to ramble. Anyway, guys, we're out of here. Thanks very much for listening, and we'll see you guys next week.
See you guys.